Our moderator for the session, Gerhard Zeelie, Divisional Executive, Property Finance Africa at Nedbank CIB. To join him for this discussion, please help me welcome Ken Osei, Principal Officer at IFC, Raghav Gandhi, Managing Director at Acorn Investment Management Limited, Joni Jones, Partner at Vantage Capital, Leon van der Moortele, CFO at Grit, and Fabio Nava, Capital Markets Director at CBRE Excellerate. Welcome.
Hello, everybody, and also welcome to my panel. So I thought I'd start off with just sort of looking a little bit back, and it's hard to say in the good old days, but you know, a while ago you could run around, raise 50% equity, and then bankers were standing queues to fund you for the other 50% at quite reasonable prices. How that has changed. But before we continue, I would like each panelist just to briefly introduce themselves. Maybe Ken, starting with you, and then we work it all the way down there.
Sure, thanks, Gerhard. Ken Osei, Principal Investment Officer at the IFC, focusing on new business and portfolio investments for Southern Africa in the sectors of manufacturing and consumer services, which for us includes tourism, retail, property, health and education.
Good morning, everyone. Raghav Gandhi. I'm the Managing Director at Acorn Investment Management Limited. We're an integrated real estate firm focused on providing rental housing, affordable rental housing. Our inception was in purpose-built student accommodation, for which we launched a couple of REITs at the start of 2021.
Good morning, everyone. My name is Johnny Jones. I'm a partner at Vantage Capital. We're based right here in Melrose Arch. We're a mezzanine fund, so sort of an alternative to senior debt funding. We invest in projects across Africa, not just real estate, but we're a generalist fund. But we have done about 10 transactions in real estate across from Egypt all the way down out to Durban in South Africa and everywhere in between. So we give a different slant on the financing side of things.
Hi everyone, I'm Leon van der Moortele, the CFO of Grit. Grit's an income fund operating similar to a REIT but having investments in 12 countries in Africa with about 1.2 billion within the group in terms of asset value and have a very diversified portfolio in terms of asset classes within the various sectors.
Morning everyone. Fabio Nava, Director at CBRE Excellerate in the Capital Markets Division within Advisory and Transactions. We assist clients, advising them on transactions in the commercial property space, assisting in any debt or equity raises in Africa.
Thank you. So let's start with something, very topical at the moment. The Fed is meeting today, where Mr. Powell is going to continue to share his views on inflationary pressures facing the US. And I think last time I saw an update, there's about a 87% chance that they're going to be hiking rates with 0.75%, and there's a 15% chance or 13% chance that it might be 1%. And also, if you look at the forecast around the base rate, the SOFR rate, that's peaking somewhere around 4.4 or 4.5%. Can't really say it changes so often. Obviously, that's going to have a massive impact on the debt component of the capital structure for investors, developers, etc. Let's start with that. What would be your views on it? Fabio, maybe can I start with you?
I mean, obviously with interest rate hike cycle, we're going to obviously see an increased cost of borrowing. I think that's the natural thing that comes through that. It's going to be at an end user basis as well as firms. And what tends to happen there is instead of spending on new projects, new developments, people will consolidate and rather save on what they've got. Having worked in the bank before going through global financial crisis, a lot of that consolidation happened because there was a lot of pressure on loan to value covenants, debt service cover ratio covenants. So that's obviously the first thing that would happen. With that, you've also got pressure on currency, and if you look at the African market, local currencies will be under pressure. And a lot of the prudential limits that banks have in these local markets are quite hamstrung. The books aren't big enough to for example, take longer term bond positions. So your tenors are already under pressure. So because of that, that capital stack is very much under pressure, where your normal loan to values will come down naturally. That means that there's additional equity that you need to put into an acquisition or a development. And your return on equity discussion, your IRRs change. And I think that's where people like Johnny, from a mesh funding point of view, would come in to assist with those sorts of deals. So I think there are certain sectors in the real estate market that will benefit. Hospitality, for example, because it's very dollar denominated or hard currency earners, they'll obviously benefit. They get a lot of, most of their income will be in hard currency, and they'll have some local currency to pay for procurement and staffing and so on. So there are some benefactors from that, but in the majority, I think we're going to see quite a bit of pressure in the market.
I mean, we're talking a doubling of interest cost, potentially, from, not from now, but, from, maybe 6 months ago to over the next 18 months. I mean, that's massive. Raghav, what's your views on the impact of that?
No, I think, of course, it's leading to a lot of challenges in order to be able to deliver the returns. I think, just as Fabio mentioned, we're having, conversations with our stakeholders to keep them posted on what we're facing, the environment that we're facing. It's not just interest rate. I mean, as developers, we're also facing significant challenges on construction costs as well, with commodity prices going up. And I think it's really about, from our perspective, it's about playing the long game, being able to communicate that, ultimately what we're in this for, in our case, providing affordable rental housing in Kenya, there is a significant demand-supply gap, which is not going to go away. And it's a matter of kind of maybe for the short to medium term, investors having to realign their expectations. But nevertheless, the long-term story is there. The long-term rationale for the investment is still there. And you just have to kind of still plug away at it.
Yes. Fabio, you mentioned, Mez, we're going to give Johnny an opportunity now to make a big pitch for Vantage Capital, but we're going to get to that. So it's not really a question on the financing, but do you think that that with the weakening of local currencies, I mean, the dollar is going to be very strong given these very high rates. It's going to be very difficult for capital, I think, to come into Africa with the yields in the US. Can the weakening of local currency be still charged to tenants? Is it possible to pass that on to tenants? And I had another point here. And can tenants, afford that? Just a view on that as well from the panel. Ken, I don't know if you want to take that one.
Yeah, so I think we should also put it in context, right? So at the start of the pandemic, central banks around the world flushed countries with cheap capital to keep economies going. So I guess you could say sort of the party is ending. And so we're actually moving not just into a high interest rate environment, but it's actually maybe a correction following the responses to COVID. So perhaps we're going to maybe a more sustainable interest rate environment, and that's part of what we're seeing. The other complication, however, around commodity prices is linked to events in the Ukraine-Russia situation, which has added inflationary pressures, which is what we're all experiencing now. If you circle back to, so what does this mean for property markets? Clearly, property is a long-dated asset class. So as an investor, hopefully, we don't all take a short view in terms of property. I think where we see opportunities, I think another panel member mentioned, is sectors such as housing,
purpose-built student housing. These are long-dated industrial assets, warehousing, distribution. And these are all areas that, as a continent, really has had underinvestment. So coming back to your direct answer to your question is, it would be very difficult to pass short-term interest rates, high interest rates, to tenants. But one would have to start to segment the market, identifying markets or subsectors within property in which to invest during this period. I think we also have to start thinking about different instruments. I think MES, some capital markets adjustments, creating instruments for these times. So sorry for the long response, but I just thought I'd provide some context.
I mean, it's quite a difficult situation that's playing out. High inflation, high rates, but potentially not the ability to pass that inflation on to tenants. Leon, what do you say about that?
Well, it is quite a double-edged sword. I mean, in reality, if you look at the class of our tenant base, most of them are able to afford these CPI-linked increases. So it does offset a large portion of your rate increases. The impact of the local currency, where a large part of your operating costs are actually denominated in local currencies, are in dollar terms, therefore reduced. So there's a lot of factors that go into it. But the reality is, you go back 12 months and we were cursing every hedge we went into because we were so underwater, whereas today you're just thanking the stars that you actually have these hedging products in place, which just helps even out that cash flow and the returns to investors on a long period of time.
Yeah. Look, I guess there is a bit of positive. I think that it will probably be very difficult, or that we're not going to be seeing a lot of new developments happening, over this time, which obviously, as things, improve, would obviously help current investors. So I do think, there's probably some positivity that one can take out of it, albeit probably not a lot. All right, maybe this is the time now to talk about alternative solutions. Let's talk about MES. Johnny, how do you see MES playing a role in the capital structure as a solution for companies?
Sure. Well, I mean, here's where we are truly alternative, and here comes that pitch as well.
Go for it.
We're a total return fund, so when LIBOR goes to 3% or 4.5% or 7%, we're not going to change our funding targets at all. And actually, relatively, we look a little cheaper. So as a mezzanine alternative, senior debt or even to equity, basically we're looking at an asset or an investment opportunity. And if it meets our criteria on a risk-return basis, we're not raising our total return targets at all. So that's where it could fit. In terms of some specifics, loan to value, you mentioned 50% was kind of a standard previously. We'll go up to 75 or 80% loan to value. And then we'll also gear an operating company kind of 4.5 to 5 times debt to EBITDA. But we do see the companies themselves battle with extra costs, and that provides higher risk for us in terms of interest costs, inflation, currency weakness. But we do see, as Leon was saying, see a lot of that price increase passed on to the ultimate tenant. Yeah. So it does provide a good hedge for what we're seeing.
I think I shouldn't have given you that much time. It feels like you're pushing the banks out. So, but I would also like maybe Fabio from your side and Raghav again is, do you see that you don't see a lot of MES providers in real estate in Africa? Why is that? Is there an opportunity for other businesses like Vantage Capital playing a role? I don't know who wants to go first.
I mean, certainly through COVID in certain sectors, I would have thought that there'd be more MES players coming to the fore. There are alternatives available, or that were available when the political will was there. We saw certain real estate, let's say, players like in the Section 12J funds that we had in South Africa that had a role to play. And it was disappointing to see that that was taken off the table. And again, I think it's a very important topic that we have here. Our industry colleagues earlier on had a panel discussion around global trends and how it's impacting Africa, and they basically spoke about what we're speaking about now. It's the value to unlock these sorts of opportunities in Africa. It's no doubt that the continent is a developing continent. we should be speaking about developments. But as the panelists have said, you've seen increase in construction costs, but you haven't seen that same increase being passed on to the tenant that can actually make those returns to make sense. So I'm surprised that during the process of COVID that there haven't been more MES funders in the space, and I've asked myself the question, why is that? Well, like Johnny had mentioned, we're not only competing with the commercial banks, we're also competing across different sectors where we're seeing a lot of investments into the tech platforms and so on. So not only are we talking competition within real estate, we're talking competition outside of real estate. And that's where we need to say, well, are the returns making sense, or should we change the model? And I think we can have a long discussion about that. We're not going to answer in 45 minutes, but I think that's really the topic at hand in Africa at the moment.
I mean, look, from our side, there are obviously MES funds that are there. That's why we've got Johnny sitting here, and there are a few others that we're aware of. I don't know how to say this. We don't see ourselves requiring MES funding. Typically it's for last mile financing, bridge facility and so forth. Maybe it's kind of fortunate, or we've been able to tie up the financing that we require for the developments that we've done. A couple of years ago we launched a green bond, which was referred to earlier, and that took care of 8 projects for us. We're about to conclude on a couple of facilities which are going to fund somewhere between 8 to 10 projects as well. So for us, I think we're in a position where we are able to access the commercial banks. We want to work with them, they want to collaborate with us, that we're able to get sufficient capital to keep us going. I suspect that we're probably not the typical borrower that a MES fund would target. Yeah. Sorry, Johnny.
No, that's right.
I hope
That's okay. We can still be friends.
Yeah. I also just want to say Nedbank also provides MES financing.
As will the IFC.
Thank you. Okay, that's enough. Then let's get to capital. Raising capital for projects in Africa. Just how difficult is that at the moment? And also, if you can look forward, what's your view on it? And maybe I'm going to shoot that Ken to you and to Leon.
Thanks, Gerhard. So I guess we're on the opposite side of the raising capital spectrum. We're a provider of capital, but we do go to the capital markets. So I think as a provider of capital, what are we looking for? We have a US dollar balance sheet. So in a declining or depreciating currency environment, equity investments become more challenging because we have to exceed our own equity hurdle rates and then basically outpace the rate of depreciation of currency. So that really leads us to being very selective. I think the MES is a very important part of that capital structure. We are an LP in the likes of Vantage. We would also design bespoke quasi-equity or MES instruments to support the development cycle with a view that once developments are up and running, you can move to a different type of... I think a key area is green bonds. So in line with the current recognition of the impact of climate, we're doing more green bonds. In fact, last week, Friday, we just anchored a green bond with Redefine, a 1.5 billion rand green bond, of which we provided 750 million rand in a mix of 7 and 10-year instruments. Now, a 10-year instrument say in South Africa would be seen to be a bit on the long side of the cycle, but we're starting to see the need for longer-term capital. And so that's another. Now, what we're able to do with instruments like that is also crowd in institutional capital to help, bring down the cost of funding. So I think from an IFC perspective, as a provider of capital, it's really starting to change the mix of the capital stack. And as folks come to us looking for capital, to be mindful that equity may not be the preferred instrument, probably more looking at MES, debt, green, sustainability instruments. Thank you.
Thanks, Ken. Leon?
I think raising capital is obviously quite a daunting task in today's environment, but it's certainly not impossible. Late last year, we actually raised $76 million through our London and SEM listing. At the same time, we actually raised some mezz funding through Ethos and Blue Peak for $31 million. So there are specific projects that actually make sense funding with these types of costs of equity. Obviously, the debt costs, which is part of your weighted average cost of capital, does increase considerably over the next probably 2 to 3 years, which you do need to take into consideration. But through that entire process, we should also remember that property is a long-term game. We're not here for the next 3 years, next 5 years, next 20 years. It's really a long-term game, and there are certainly projects out there that are beneficial enough to take the higher cost of funding and actually put them and deploy that cash. We also don't want to get into a situation where you stagnate the provision of these properties to our tenants. Being a very tenant-led business, tenant-focused business, we're always in discussions with what their needs are and where the changes in properties can actually increase their returns. Through certain projects we can do some developments and sort of add-ons or refurbishments at very substantial returns, which even makes sense with a higher cost of capital. I think where the environment's going to change is, I think there's going to be a greater responsibility on a lot of the mezz providers, as well as the likes of the IFC, Development Bank of South Africa, to continue providing these homes for corporates. We forget that to develop Africa, one of the key considerations is to make sure that people have their corporate homes. These are not just offices. People go to these places every day. And it's quite crucial that these are in place so that we can develop more jobs in Africa and really keep pace with the requirements as the growing population in the continent.
Thanks, Leon. So one of the other things that I've always been, that I've always thought was very, very strange is that the REIT market in Africa, that has not really kicked off. I'm not talking about South Africa, of course. Obviously, that would be a great source to raise capital, but it hasn't really flourished. Well, flourished is probably the wrong word as well. Why is that? Leon, maybe just your views on that.
Yeah, I mean, it's something we embarked on in a number of the jurisdictions that we were operating pre-COVID. And it was a bit of a minefield. It was new regulations. There was a lot of new tax law, even some accounting issues in the likes of Morocco, where there was just these big impediments to actually getting it to move forward. But there's the whole microcosm around REITs that needs to work for it to actually flourish. So the reality is there's 54 countries in Africa. Each one of them have got their own style of REITs, their own sort of requirements. The regulatory costs around the REITs is very expensive. And you get to a point where you need significant scale so that the asset managers can actually be moving forward and creating these REITs, but at the same time where that fee burden on the actual REIT investors is not overburdening their returns. The other issue you have is who's your investors in the REITs? Most stock exchanges in Africa suffer from liquidity issues. There's not a big middle market where the retail investors become a large portion of your investor base. So you're relying on pension funds and you're relying on international capital. The issues you're having, though, is specifically in a lot of African countries where the pension funds have got a lot of direct property exposure that are pre-existing. You have competing capital for sovereign bonds, which are generally at higher yields than the REITs are going to establish. So it does become a bit of an issue of where to actually go to raise this capital. And certainly there's more scope for different types of products. I mean, if you look at the success of cell phone banking as an example, there must be some hybrid there in the world where we need to evolve with the times and attract smaller scale investors where there's less costs involved in getting in and out, insurance-backed products for investments on a smaller scale to actually target the people of Africa to be participant in the entire value chain of property.
Yeah. Raghav, you're from Kenya. The same question to you in respect of the REITs.
Yeah, I mean, I think it has been a challenge. I had a head full of hair when I started, but I think there's a couple of competing elements to why maybe there has been a little bit of resistance to REIT uptake. In Kenya's case, The first REIT that was launched, it was soon after the REIT regulations were announced in 2013. I think there were a few missteps that took place, not necessarily the fault of the issuer, but in terms of valuations, in terms of the investments that were selected, and I think that kind of put a dampener on the reputation of REITs in the country, and that's something we've had to try and address and try and work with. I think the other thing is that a lot of the patient capital that we try to attract, particularly from pension funds, has this appeal of trying to do real estate themselves. They want to do direct investments as opposed to indirect investments. So with that kind of confluence of factors, it's involved an element of or kind of significant work in building up market knowledge and market understanding. It's required patience from us. Would we have liked to be able to ramp up the REIT much more? Yeah, sure, fantastic, right? But as has been kind of reiterated a couple of times, it's a long game. It's a patient game. We talk about long-term returns to investors. So, if in the beginning where people want to take a wait-and-see approach, as far as we're concerned, we'll wait and see with them. But I think as and when they see the track record that that we build up, and the capital will start coming in. And I think on top of that, what hopefully it'll also do is bring some greater confidence within the sector so that other issuers can come along as well. And that's something we're seeing. I am of the firm belief, based on some let's say insights that I have, that I think you'll probably see at least a couple more REITs being launched in Kenya in the next 12 months. And I'm sure there are many more in the offing. So it's you just gotta hang it out and keep plugging away. That's the way I see it.
Okay, Fabio, a question to you on DFIs. What role do you think, given the this sort of the dark clouds sort of stacking together a little bit, what role do you think DFIs can play?
A lot of the good that DFIs are bringing are, they look at not just the real estate elements to it. That has to tick the boxes, no doubt. And the EDGE certifications, for example, has to tick the box, no doubt. But it's about the human element that it develops in that node, wherever that development takes place. So it's very strenuous to get a deal through a DFI, because they do that much effort and so much more in that element, in terms of, does the capital stack make sense? Does the real estate fundamentals make sense? Okay, what's the human element impact on this development? And then I think what I like about these DFIs is they can take it, there's almost that commercialization of a family office, where they can take it to the next level and then start talking about portfolio rollouts for these sorts of let's say clients. And I think that's important. You need that in an African context when you are developing throughout. I think the challenge that a lot of commercial banks and industry leaders have is it's difficult to see 5 years in advance. I can assure most of the audience, where they've said that this is where we're going to go in 5 years today, 5 years back from a power supply issue. I don't think so. And that's the challenge that a lot of us have, and that's where I think the DFIs have patient capital. And I think a lot of the panelists have said that that's the important bit, is we need that patient capital. So yeah, I think that answers that.
Ken, I'm sure do you want to add to that maybe?
Yeah, I mean, absolutely. So I think just to add to that is, as DFIs, we have to take a very long view of the role of property on the continent. I mean, so property is actually part of commercial property's business infrastructure for a continent that lacks it. Retail property is basically bringing an aggregator of produce, FMCG, and creating a sort of an ecosystem for jobs. Industrial properties in a continent that has a lot of resources but doesn't have a place to put it. Student housing similarly is creating sort of a, and then also I think on the question of instruments such as REITs, right? So creating instruments and participating. We invested in the Fahari REIT.
I wasn't going to say that.
And I think, innovation is nice, but can be an unpleasant experience. We don't have anything to show for it in terms of returns, but we do it nonetheless, right? We've invested, I think Lango Real Estate is with Growth Point and a few other investors. We're proving an asset class, so an income-producing, multi-country property investment. So sometimes, we have to go into the market, take a long view, work on a new instrument, work with others. I mean, there's a few asset classes, the presentation by CBRE, for example, on data centers, on a continent that is underserved in terms of connectivity. So these are all areas that we will look at, but with a very long view. We also have to look at other aspects such as macro, because we're working in a different context. And then, of course, being mindful of what's needed. So we play in several gateways, direct investment, investments to support development, investment on income-producing assets. So and then, of course, on the ESG side, very, very strong. So it's a bigger ecosystem approach rather than sort of the next 3 to 5 years. So that's our role. Thanks.
Okay. One thing is around, capital or funding being earmarked for specific subsectors. Is that something that you see? Anybody from the panel that maybe has a view on that? Are there, for instance, subsectors where it's much easier to raise capital in, be it equity, mezz, debt?
Look, I think there's a few products there that you certainly can get easier funding for. I think there's been a lot of talk today about data centers, which is certainly an underserviced area on the continent where the likes of the mezz funding, but also the operators themselves who would like to co-own the property asset as well, which is quite good. So there's multiple assets that do need to be put into the ground sooner rather than later, specifically logistics within the African continent. And, looking at further field where investing in the likes of these SEZ zones where it makes a lot more sense, putting up these types of structures, there certainly is the ability to deploy capital profitably, even with the high cost of capital. But it's certainly become a lot more niche in terms of each project. There's no more shotgun approach in terms of just raising equity and deploying it. You've got to be very finite of matching your capital to your project.
And also, the source of capital, do you see that is mainly, what's the ratio? How much of that comes out of Africa versus outside outside Africa? Johnny, would you like to take that?
Yeah, we just raised our Fund 4, and I'd say 70 or 80% of the capital came from Europe and a little bit from the USA. Whereas we had a larger proportion of capital from South Africa in Fund 3. So we actually saw, and it's because of the DFI component as well. DFIs see fund managers who can deploy capital, like Ken says, and this part of the economic cycle where there's a lot more risk and pressure, DFIs actually came more to the forefront, and they see some of the benefits. So we got a good portion of DFI money and some pension fund money as well, in part because we do dollar funding, and they like that kind of dollar component with our loans. So South Africa actually reduced relative to offshore and outside Africa for this fund relative to the last one.
Maybe in conclusion, let's just quickly talk about bonds. And, we're talking green bonds. I think there's probably, what I'm seeing is going forward, very little financing will not have an ESG component to it. I think that's just where things are going. But let's talk about bond financing. Raghav, I know at one point your business had some bonds. Do you think the refi risk on bonds is a lot more maybe than bank funding? Your views. Do you think it's better than bank funding? What are the benefits?
No, I think I would see, as far as bonds are concerned, that refinancing risk is greater. At least that's the way we saw it. And it was, particularly when we launched the first tranche of the green bond, that was one of the key risks that was identified for us, and we had to try and address it. So, in a way, what we did was we downsized the first tranche just to be able to kind of bring a little bit of credibility and show to the capital markets that we could actually manage this thing. You know, as far as the green bond is concerned, it's actually not in our plan to look at refinancing. That's not where we're going at it.
Okay.
I think with with kind of the vanilla bank loans, that's something we would explore if necessary. But you know, the model that we have, essentially because the development REIT, so there's, like I said, there were two REITs. There's the development REIT and an income REIT. The development REIT is the one that utilizes the green bond, you know, as part of its debt component. When a project is developed and it gets transferred into the income REIT, which is the other REIT, which holds on to steady state properties, we just look to pay off the debt component of that green bond, rather than look to refinance it. And the other thing to note is that, of course, you know, we didn't really touch upon this, but we're also, I think this applies to many countries in Africa. You're operating with an inverted yield, where you know the cost of financing is actually less than what the typical yield you get on real estate. So in that sense, it just makes the economics, you know, it more sensible to just look to repay the loan as quickly as possible.
Okay.
Yeah.
Thank you very much.